you, Jane. Good afternoon, everyone. I'm Edward Paull. I'm one of the medical directors at Lentells. I'm going to talk about staff benefits and whether they're taxable on the individual employee. I'm also going to touch on national minimum wage and its financial impact on your practices. So, staff benefits. Staff party costs. So staff party costs are normally paid by your employer, hopefully. They're not a taxable benefit for the individual employee, so there's no tax to pay for the employees if the total cost per year doesn't exceed £150 per head. It has to be open to all staff and it has to be an annual event, so either Christmas party or summer barbecue. The £150 per head is a limit, it's not an allowance. So if the cost is £151 per head, the whole amount is taxable on the employee. So if it's £151 per head, the employees would need to pay tax and national insurance. If there are multiple events in the year, if they all add up to under £150 per head, and this is the tax year, it's not taxable. There's nothing to report to HMRC. If they go over £150 per head, you can look at the individual events in the year. For example, if there are two events and one was £100 per head on average and the other one was 70, in total you've gone over the £150, but you can look at the individual event and the £100 one could be made exempt. So there'd only be tax and national insurance due by the individual on the other event. Any subsequent events in the year would be taxable by the individuals. Cash. So all cash has to go through the payroll. So any work done by your employees, if they're paid cash, no matter how small it is, it goes through the payroll. Cash vouchers. So if it's non-cash vouchers, so if it's high street store vouchers which can't be converted to cash, or if it's other gifts, so it could be wines, flowers, chocolates, if the monetary value exceeds £50, it's taxable. It's taxable on the employee. So it has to go through the payroll and the individual pays the tax and national insurance due. Alternatively, you can do something what's called a PSA. It's a HMRC PAYE settlement agreement, and I'll talk about that in a minute. If it's £50 or under, it's not taxable, as long as it qualifies as a trivial benefit. So trivial benefits, there's nothing to pay by the individual if all of the following apply. The cost per head doesn't exceed £50, it isn't cash or a voucher that can be exchanged for cash, and it isn't a reward for their work, and it isn't in their contract of employment. So at Christmas, if you pay staff vouchers, you can pay up to the £50 limit, as long as they're vouchers that can't be exchanged for cash. So high street store vouchers are fine, and they're not more than £50, they're exempt. They're tax-free, there's nothing to report, they don't go through the payroll, there's no tax to pay for the individuals. The moment you go over £50, they're taxable, and it's the whole amount that's taxable. So if you pay vouchers £55 per head, £55 is taxable on the individual. And you need to put them through the payroll. There's also no limit on the number of instances you can do this. You can provide staff vouchers at Christmas, say £40 or £50. You can provide them with further vouchers at Easter time, or whenever throughout the year. As long as they don't exceed the £50 limit, they're not taxable. There's no limit on the number of instances. You do need to be wary of the reward rule, though. It's not a reward for their services. So you can pay Christmas vouchers at Christmas because it's Christmas, or perhaps you can pay someone else a monetary gift because it's they've had a newborn baby, or so on. Other non-taxable items, I'm just going to touch briefly on this. So subscription costs. Subscription costs, so you're paying a subscription cost for your employees or reimbursing their costs. It's not a taxable benefit for the individual, as long as it's a tax-deductible expense. It's a tax-deductible expense if it's on HMRC's approved list of subscriptions. So on their website there's a list of subscriptions which goes on and on and on, and if it's on that list it's tax deductible. There's no benefit then for the employee. Mileage reimbursements. So on the slide you can see the mileage reimbursements, so 45 pence a mile for up to the first 10,000 miles and 25 pence per mile over 10,000 miles. This is for staff using their own cars for business trips. So if you pay the approved rates, so 45 pence a mile, there's no tax to pay for the employee, and that you don't need to report it to HMRC or put it through the payroll. If you pay more than the approved rates, the employee needs to pay the tax and national insurance on the difference, which is usually put through the payroll. If you pay less than the approved rates, the employees can claim the tax relief back up to the 45 pence per mile by writing to HMRC. How do we report taxable benefits? Usually, taxable benefits are reported on the form called P11D. So it's a HMRC form used to report taxable benefits to declare non-payroll benefits. It needs to be submitted to HMRC by the 6th of July, following the end of the tax year. There are quite large penalties if the forms are late, so £100 for each block of 50 employees if the forms are late. You also need to provide the employee with a copy of the form as well. The employee then, if they submit tax returns, they put it on their tax return and pay the tax that way. If they just have one employment post, it's adjusted in their tax codes. If there's any national insurance dues, there's sometimes there'll be national insurance due by the employer on some of the employee benefits. The employer would pay Class 1A national insurance, is payable by the 19th of July by cheque or by the 22nd of July online. You can also enter into a HMRC PSA agreement. So it's used for small one-off benefits to staff, so such as vouchers or gifts. These would not be the trivial benefits. The trivial benefits would be exempt and they don't need to be reported. So these are gifts to staff or vouchers over the £50 allowance. The PSA is an agreement with HMRC to report the tax and national insurance due, which is paid by the employer. The advantages of entering into a PSA agreement are that you don't need to put the benefits through the payroll, you don't need to complete P11D forms. The deadline to apply is the 5th of July, following the end of the tax year, and any tax and national insurance due is payable by the middle of October. You do need to write to HMRC to cancel the PSA agreement in future years because it automatically renews. I'm also going to talk about rising staff costs. So on the slide you can see the new national minimum wage rates. For 25 and over is actually called the national living wage, and the rest are called the national minimum wage rates. So the national living wage rate is now £7.83 per hour. That's an increase of 4.4% on the previous year. To give you some idea of how much the rates have gone up in the last few years, in 2014 the minimum wage rate was only £6.50 per hour. So it's a 20% increase in the last 4 years, and that has an impact on your practice finances. The rates are law, they must be applied. The original projection for the national living wage set by the previous Chancellor, and it is just a projection, is that the national living wage would be at £9 per hour by April 2020. Just a note on apprentices. Apprentices have their own rates, so if the apprentices are in their first year of apprenticeship, the minimum wage rate is £3.70. To go on to the national minimum wage rates, the rates above on that slide, they need to be in the second year and also be 19 and over to qualify. Just to show you an example of the impact on the national minimum wage, so one worker working full-time, 37.5 hours per week, the additional gross pay would be nearly £650. By the time you add on the on-top costs of national insurance and pension, the total cost for one employee, 1 year, the extra cost is over £800 for your practices. I'm also going to touch very briefly on auto-enrolled staff. So pension costs are increasing. This is not the NHS pension scheme. NHS pension scheme rates have not changed. This is for staff who are enrolled in an alternative workplace pension because either they're not eligible for the NHS pension or they've stopped contributing. So employer rates up to the 5th of April 1%. From the 6th of April onwards, they're 2%. So costs have increased, costs have doubled. This will only affect a few usual staff in each practice if they're not in the NHS pension scheme. From April next year, it's going to be 3%. So it's just to give you an idea that costs for alternative workplace pension schemes are increasing as well.